There was one number this week that mattered more than the 800-point drop in the Dow, more than the meta sell-off, more than the barrel of oil that fell and then leapt back. The number was 520, and almost nobody led with it. Let me tell you why it's the only number that actually matters. Here's where we start. The market came into this week holding two very comfortable assumptions. The first was that the war between the United States and Iran was winding down. Oman and Pakistan had broken a lull. Israeli Prime Minister Netanyahu had flown to Washington and called the talks the best he'd ever had. And oil, which had been over $100 a barrel, drained all the way down to the mid-80s as the war premium bled out of crude, session after session. The second assumption was about the Federal Reserve. With a president publicly demanding rate cuts, the market expected the Fed to at least signal the easing was coming. Both of those assumptions broke, almost at the same moment, inside 8 hours. On Wednesday, the Fed held its benchmark rate steady at 3.5 to 3.75% for a fifth straight meeting. But the vote was 9-3. And here's the part that caught everyone off guard. All three dissents were for a rate hike. Not the cut the White House wanted. A hike. Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan each pushed to raise rates, pointing to inflation still running above target because of the energy shock. It was the first time since 2016 that three officials dissented in the hawkish direction all at once. A market positioned for doviness got a hawkish minority instead. The odds of a September hike jumped past 57%. The Dow shed about 800 points. And the number I opened with, the yield on the 30-year Treasury bond, vaulted to 5.20%, its highest level since 2007, the year before the last great crisis. Then, overnight into Thursday, the second assumption broke too. U.S. Central Command confirmed fresh strikes on Iran in response to attempted attacks on American forces in the Gulf. The lull the market had been pricing as peace was over. Oil snapped roughly 5% higher. Brent back above $90. The war premium that had drained out on Tuesday was right back on the tape by Thursday morning. And underneath all of it, the artificial intelligence trade didn't crash. It soared. In a single earnings night, Microsoft rose about 8% as its Azure cloud business crossed $100 billion in revenue and its spending plan held steady. Meta, however, fell 8% on nearly identical revenue growth. The market stopped punishing AI spending across the board. It started paying only for the companies that turned that spending into cash. Now, here's why the consensus read of this week is looking at the wrong screen. The consensus says the equity sell-off was the story. Bad Fed day, bad tape, buy the dip. That's not wrong exactly. It's just watching the loud screen and missing the quiet one. The decision grade signal this week was in the long end of the bond market, and it's structural. It is not a tantrum. Here's what the equity headline misses. A 30-year yield at 5.20% is not just a quote on a screen. It's a discount rate. It sits underneath every corporate valuation, every mortgage, every leveraged buyout, every infrastructure project financed over a long horizon. When that number moves from the low 4s to above 5 and stays there, the present value of the entire future economy gets marked down, quietly, everywhere, all at once. This is the cost of capital resetting to a level that an entire generation of operators has never actually run a business inside. And it's being driven by a Fed whose internal gravity now runs towards tightening, even as the political pressure runs towards cuts. That's the real meaning of that 9-3 vote. Chair Kevin Warsh has stripped forward guidance out of the Fed's statement and is holding in the institution's line on data over politics. The bond market read the dissent correctly. This is a committee more likely to hike than to cut if Middle East oil reignites, which 48 hours later, it did. The long end isn't pricing a policy mistake. It's pricing a Fed that will not blink, an inflation impulse with a live energy fuse, and a federal deficit that's funding a war. Betting on a return to cheap money is the bet that costs you here. So let's talk about what it means. The corridor angle in 3 parts. First, for capital. This rotation is no longer subtle. It is not really about AI at all. It's about duration. Money is leaving anything priced for a zero-rate future and moving towards proven cash and hard assets. That's why Microsoft and Meta split 16 points in a single night on almost the same revenue growth. At 520 on the long bond, the market will finance the compounder and starve the promise. So check your concentration in anything whose valuation rests on cash flows a decade out. Those flows just got repriced. Second, for operators, stop treating your cost of capital as a number you inherited and start treating it as a strategic variable it has become. Every model you build assuming you'd refinance at 2021 rates is now stale. Term out your long-dated financing while you still can, because a hiking-biased Fed and a 5.20% 30-year are both telling you that cheap money is not coming back on the old schedule. And read energy as geography, not as a line item, because a war that reprices oil 5% in a single night is the same system that keeps the long end elevated. The inflation the bond market fears and the strait that tankers can't cross are one story. Third, and this is the corridor thesis proper, for Canada, this is where the divergence becomes the opportunity. While Washington's Fed was signaling higher for longer, the Bank of Canada held its rate at 2.25% and bet openly on a rebound. That's a widening gap in the price of money on the two sides of the border, and it lands in the same week that Ottawa is negotiating against the clock. Washington has revived Section 338 of the Tariff Act of 1930, a law that had gathered dust for nearly a century, to impose a 50% wall on roughly $20 billion of Canadian goods. But energy, potash, and critical minerals were carved out. Prime Minister Mark Carney declined to retaliate dollar for dollar, and he's intensifying talks inside the window. I've watched governments negotiate under exactly this kind of pressure, and our team reads that exemption list as the single most important sentence in the whole order. Washington just told Canada, in the plainest language it knows how to speak, exactly where Canadian leverage lives, in the molecules the American economy cannot substitute. The country that prices U.S. market access as a political variable rather than a birthright and builds the resource corridors to prove it, that country turns this insult into a decade of positioning. So let me leave you with what to do and what to watch for. Do 3 things. Rebuild your operating model on a long rate above 5%, not the 4s you'd banked on. Term out your long-dated financing while the window is open. And if you carry Canadian exposure outside those exempt categories, treat U.S. access as a rising political cost and diversify the buyer, not just the product. And watch for gauges. The 30-year yield itself, above 520, is the tell that this is a trend, not a spike. Friday's inflation reading, the PCE number that decides whether those 3 hawkish dissenters were right, the ceasefire signature, until one is actually signed, price the oil volatility, not the resolution, and the August 19th tariff clock, where the real question is whether the provincial hawks force Carney's hand before the window closes. The operators who get surprised next quarter will be the ones who watched the equity screen and missed the bond screen. The Dow's 800-point will be forgotten by autumn. The 520 will not. The map you financed for, the one drawn in the cheap money era, is being redrawn right now. Build for the one that's arriving. If you want those 4 gauges tracked every single morning, the long end, inflation, the ceasefire, and the Canada clock, that is exactly what the corridor briefs do. It is free and it comes straight to you. No algorithm in between deciding whether you see it. You will find it at brief. And the link is right at the top of the description. So please, do 2 things before you go. Subscribe here on YouTube so the next video finds you. And put your email on the brief so the analysis reaches you every morning either way. I'm Joseph Soares. See you in the corridor.